Let's talk about tax evasion or tax fraud. How does the IRS decide when a case turns criminal? What most people get wrong about tax evasion. Most people think tax evasion involves hardened criminals hiding money in offshore accounts. Well, in reality, that's not how most tax crime cases begin. In reality, many tax evasion and tax fraud cases start with ordinary taxpayers, business owners, and professionals, all of which who made decisions under pressure and didn't realize how the IRS would interpret them after the fact. The key issue to discuss here is your intent. Not math, not the mistakes that occur, your intent. What were you thinking when you signed that tax return? Did you know you were cheating the government? Let's talk about what tax evasion actually is. First of all, tax evasion is not an accident. It's defined as intentionally attempting to reduce or avoid taxes by providing false or misleading information. This can include underreporting income, claiming deductions you knew were improper, claiming credits you weren't entitled to, reporting personal expenses as business expenses, keeping two sets of books, failing to file returns when you knew you had a legal duty to do so. The government doesn't need to prove that you actually succeeded. They only need to prove that you acted willfully in attempting to do so. Let's talk about why civil audits turn criminal. Many criminal tax cases don't start off as criminal. They often start off as straight civil audits. During audits, auditors are trained to look for badges of fraud. Badges of fraud are situations that run with fraud the government's used to finding. That includes inconsistent explanations, missing or altered records, patterns across multiple calendar tax years, criminal omissions that were made casually, emails, drafts, and work papers that contradict the tax return. Once an agent believes the conduct was intentional, the civil audit can stop immediately, and then the case is referred to the Criminal Investigation Division. At that point, the rules change completely. The danger of attempting to fix this type of thing yourself. This is where many taxpayers make things exponentially worse. They try to explain what they were doing to the auditor. They try to correct it after the fact. They often talk too much. Or worse yet, they contact their accountant thinking it's safe to do so. Here's the problem. Accountant communications are not protected by attorney-client privilege. Any emails, drafts, notes, or explanations created with your accountant, that can all be subpoenaed. In many cases, the very accountant you turn to help you can wind up becoming government witness number one against you, even if they have no desire to do so. Also, trying to quietly amend returns after the fact or submit corrections without legal strategy can invariably create concrete evidence of tax fraud instead of providing you the protection you seek. Here's where voluntary disclosures can help. They are powerful, but done wrong, they are dangerous. Voluntary disclosures can be a powerful tool when done correctly. They can allow taxpayers to correct intentional tax fraud without facing criminal tax prosecution, but timing is everything. Voluntary disclosure only works if you engage in it before the IRS contacts you or receives third-party information. Once a criminal tax investigation or audit begins, these doors slam shut. Worse yet, doing a voluntary disclosure incorrectly can lock in criminal tax admissions that prosecutors can later rely on. This is never something to attempt without the correct legal counsel. Not a CPA, trust me, only an attorney. Here's where a dual licensed attorney and CPA really matters, where we shine. Tax evasion cases ordinarily sit at the intersection of law, accounting, and criminal tax exposure. You need to hire somebody who understands how the IRS thinks, how prosecutors build criminal tax cases, and how privilege work. Both attorney-client privilege and work product privilege. Someone who knows how to control information flow how to resolve tax liabilities without creating criminal tax evidence. That's why working with a dual licensed tax attorney and CPA is absolutely critical in high-risk tax cases. This combination allows legal strategy and tax resolution to move forward together under privilege. So in closing, what should you do if you're worried? If you're losing sleep over past tax filings, and that involves unreported income or aggressive tax positions, don't wait. The biggest mistake you can make in an audit or after the fact is hoping the IRS won't notice. If action is needed, it must be done carefully, strategically, and under attorney-client and work product privileges. To discuss your situation confidentially, contact the tax law offices of David W. Clausing to schedule a reduced rate initial consultation today. Call 949-681-3502 or visit clausingandassociates.com to book a reduced rate initial consultation today. Thank you.